This video today is going to be an evergreen piece of content. It's a lesson about business and investing. Sit back, relax. It's going to be probably quite a long one. It's going to be like a conversation. So we can talk together and discuss what our mindset should actually be. Like, what is the meta? What is the meta thinking about doing business and investing? Okay. So this is quite a bit of a nuanced topic that I don't really hear discussed at all on social media. Let's dive into it. There's quite a lot of moving parts. Hopefully, by the end of it, you get a good understanding about my mindset when it comes to business and investing. So, first thing we need to think about is we have, as investors and business people, we have been fortunate enough that someone has created a thing called the S&P 500. The S&P 500 on average has produced around 10% returns annually. Yeah, some years are down, some years are above that, okay? But it averages out to around 10%. The great thing is that's like 10% after tax, because if you just hold the thing, you never pay tax, okay? So this is the gold standard of making money, okay? It's the gold standard of investing in business, okay? So that means if we want to invest ourselves, either, or do business, we either have to say to ourselves, do I think I can actually beat that? Or should I just join it? Because imagine you go down the investing route and then you create this portfolio and all of that, and then you make 6% returns. Dude, why are you doing all of this work for no reason? You could just park your capital in the S&P 500 and do nothing, and you make 10%, okay? You make 10%. We have to think about it realistically, and we have to be honest with ourselves. So then, if our goal is to outperform the S&P 500 in a significant and realistic way after taxes, we have to then first look at ourselves. Do we honestly think we have the ability to do that? Okay. This is kind of like, everything in life. I highly recommend to study game theory. Investing in business is a game, right? Just like there's games like basketball, there's games like professional esports. There's games like swimming. There's games like running. There's dancing. There's singing. There's all these different ways to make money. These are all different games, and some people are better at certain games than other people, right? Like, I know for myself, I'm never ever going to do basketball because, first of all, if I am to analyze myself, I'm bloody damn short. I can barely jump. Most of my body weight is in my upper body. I've got these little legs on me. My legs suck, man. My legs, they just don't work, all right? That's one thing. And you could say, "Oh, but Dylan, like, don't doubt yourself. Like, you'll be able to compete with them." Dude, I don't even like the game. I don't even like basketball. Even if I was the tallest guy in the world, I don't think I'd like it. Why? In terms of psychology, I don't like trying to like get it and go for the little, three-pointer swish. I'm more of an aggressive guy. I like to smash that shit. Like, I wish I could just get a baseball bat and smash the ball and like go for a sixer. I'd probably I'd probably lean more towards cricket or baseball. I want to hit a home run. Yeah, ball's coming at me. Boom, she's gone. See you later. I don't want to be all nice and just get a little swish on the basketball hoop. So it doesn't suit my personality. It does not suit my genetics. It doesn't suit me at all, basketball. Okay, you can go down the list. I'm actually bad at many, many, many things. Honestly, I think everybody should do this. Do an honest reflection. Which games you're actually good at, you should probably focus on those games. Okay. Now, when it comes to investing in business, I like it a lot because it's more about our minds. I like it because it's based on, yeah, one, intelligence, but it's also based on like your mental, like your grit. Like, sometimes I like to say, do you have the dog? Do you have the dog inside of you? Because that helps. That can actually help if you learn to control it. I think Jordan Peterson said it like, if you can learn, if you can become a monster. First become a monster, yeah? Then learn how to control it, all right? And apply it to the game. Apply it to the game, the world of investing, the world of business. In the world of business, it makes more sense, like understanding grit, because sometimes you can brute force your investments. You can work really hard in your business, and you can force it into making more than the S&P 500. And You bloody hope so. Why? If you're working really, really hard at your business, that's not passive. The S&P 500 is actually passive. You click and you sit on your hands and you do absolutely nothing. So if I am to do more work, I better get rewarded for it. Okay. I better get rewarded for it. That is my mindset. I don't want to do work for no reason unless it's like some sort of like altruistic thing, like, hey, I'm doing work and it's not for me, it's for other people. All right. That's different. But we're talking about making money here. Okay. So in the world of making money, we have to be honest with ourselves. Do we think we're that person? Now, at the beginning, you could be a little bit confused. That's fine. But you could think, hey, like I really like investing. I really love business. I just want to test it out to see if I have what it takes. Right? That's fine. That's fine. In that scenario, I still would first think about just creating a nest egg in the S&P 500 or something similar. So then you have that money to back you up. Like one of my things is I truly believe if you're living in Australia, yeah, there's cost of living and all of that, and it's hard, right? I understand. But if you grind your ass off at a job, then you can. And if you sacrifice, you can save $100,000 pretty damn quickly, like within 4 or 5 years. You can save that money, invest that into something like the S&P 500, and now you've got like 10K coming in every year. Let that compound for a little bit, and you've got even more money backing you up, backing you up, backing you up, backing you up. It is a big mistake where some people they just have such big egos, saying that they're way smarter than the S&P 500. They're a sophisticated business person. I can make a lot of money. Dude, they just fail again and again and again and again and again. Some people are delusional where they just never give up and they just never make any money. Like I've sadly met a lot of people like in their 50s and 60s where if they had just gotten like 100K invested into the S&P 500, done nothing since then, they would have a lot more money than they do today. They could have worked for 5 years, invested in the S&P 500, done nothing else, and been better well off financially than they are today because they got this ego and this delusion about them that they're the business guy. All right. A thing that I hear, like a common thing, is I hear about these people. I say, like, so what are you working on? They're like, oh, working on a lot of things. It's always a red flag. Working on a lot of things. What are you talking about? Like, if you want to outperform the S&P 500, bro, you need focus. Focus on something, okay? So, outperform the S&P 500 is actually not easy. It is actually really really difficult. That's why most of the advice you hear online is saying just invest in the S&P 500. Just join it, right? So, where does this actually come from? Like, whenever we're speaking, like right now, I am speaking in such a way that, the context of this video is I said, hey, it's a more nuanced video. So it's for a more sophisticated person. It's more advanced knowledge. So then that's kind of like the demographic that I'm speaking to right now. But most of the information that you hear online, like that's a small niche. So I'm speaking to a small, little, tiny niche right now. Okay. A small, tiny, little niche. But when most people speak, they speak to the overall demographic, the overall market. They're speaking to everyone and they're just generalizing. So when like Warren Buffett speaks, he's speaking, he's generalizing. So when he says like, hey, just invest in the S&P 500, he is generalizing. Okay. Now, if you are to start a business is actually a form of investment. Okay. They're not two different things. People also think like business is business and investing is another thing. All right. They can look a little bit different, but actually, you should have the same mindset when you think about these two things, okay? Because they're about making money. We're in the money game. Business is money. Investing is money. They're the same thing, okay? Now, people kind of put themselves in a box when they think about business. Like, hey, I have to be like in my shop or, don't think like that. Think like an investor or think like a money person, okay? So let's change investing and business to money person. I'm a money person. I'm looking to make money, okay? As an example, people don't realize, like, imagine you look at a big technology company like Apple. People think Apple is, hey, we make devices, we make phones, We make computers, we make iPads, we make headphones, we make physical devices, and they make some other things as well. Okay, but that's what comes to mind. They more think about the physical stuff. Okay, and obviously they have all the software side, and that's huge as well when you look into it. Now let's think. Hang on a second. They've got a software side. Is that like a diversification? See where I'm going with it? Diversification. What's that supposed to trigger in your mind? That's supposed to trigger investment. Okay. Oh, type in Apple acquisitions. What companies have they acquired? Who acquires things? Investors acquire. They buy shares in things. In Apple's case, they buy the whole company. So they buy all the shares. Okay. Apple, they're actually investors. Okay. CEO Tim Cook, he is an investor. He's looking where to allocate the capital. Even with, within the Apple actual business, you have to think, all right, we have a certain amount of profit being generated every single year. Where do we allocate that capital inside of Apple? How much goes to making iPhones? How much goes to the research and development team? How much? You have to think like an investor, and you have to allocate the capital correctly. Again, what is this? We're talking, this is the money game. Okay. This is the money game. Now, something that gives me a bit of credibility, I should have probably said this at the beginning. All right. I'm decently okay at this thing. So far, I've been making like 30% returns on eToro, stock market investing. I believe, in my opinion, like you can eventually hit a certain level if you study well and really dedicate yourself. I'm talking, it's not easy though, because there is just so much information in this world. And you got to sort through all of that information. It's like finding a needle in a haystack, but eventually it is actually quite easy to outperform the S&P 500. I'll prove it to you right now within a minute or two. Everyone says you can't outperform the S&P 500. Here's an example. You get 90%, you go 90% S&P 500, you go 10% NASDAQ 100. The NASDAQ 100, the benefit of it is there's only 100 companies instead of 500. It's more concentrated towards tech. Tech, I believe, is going to outperform the more standard stuff, right? Especially with AI and all of that coming up. I believe that portfolio, 90% S&P 500 and 10% NASDAQ, will outperform a portfolio which is 100% S&P 500. Make sense? Okay. Now, you could do that. You could even buy like a slightly leveraged S&P 500. Do the same thing. 90% S&P 500, 10% on that leverage thing, right? So you can buy like leveraged assets. Like we've got them in our eToro portfolio. That's why we're actually quite aggressive. Now, you can buy these leveraged assets, which move some of them like they move like double. Like whatever the S&P moves, they move double. So on average, so if it goes up, it should go up. Like if the S&P goes down, like it's right now it's down 1.6% today. It should go down roughly double that. Okay, but then when it goes up, it should go up roughly double that too. So it's pretty good because most days or most of the time the market's trending up. So over time, if you go and check the history of it, it's actually been outperforming the S&P 500. But there's a consequence to that outperformance, which is volatility. It means the volatility means the thing goes up and down faster. Okay. So there's two examples. And another example is, let's just say, like with Bitcoin. Bitcoin, if the S&P has been going up average about 10% every single year, I'm pretty sure like Bitcoin, I don't think is going to get the crazy returns it once did. Like some people look at like, oh, the average return of Bitcoin is like 150% annually. Yeah, but that's different, man. That's different because it's based on market cap. Like Bitcoin doesn't produce anything, right? It doesn't produce anything. Like let's say with Apple, it produces a 20% return. It produced a profit. Bitcoin is not like that. It's based on supply versus demand, okay? So previously, the asset class was like once $1 billion asset class. Just $1 billion. So if like 1 billion came in of if there was a net of 1 billion of buys, that actually skyrockets the market cap. Like most people think, oh, if $1 billion of buys comes in, that means the market cap would go from 1 billion to 2 billion. It doesn't work like that because it will just smash through the order book and it will just skyrocket the price. Like I'm guessing it would actually go up 10x. Like if $1 billion of net buys came in, The price, if the market cap was a billion, it would go up to like 10 billion. Like, I don't know the exact math, but like, it's not what you think. Okay. Like, you have to study and understand market caps and understand how they move. Now, that's why the average returns of Bitcoin, they're actually getting smaller and smaller every year. So it's not fair to do like a 10-year average. It doesn't make sense. It does make sense to do a 10-year average of the S&P 500 because it's companies which are producing something. They're on average producing the same returns every single year. Bitcoin's not producing anything. It's based on supply versus demand and market cap. If you got in early, you made a lot of money. If you come in today, you might make good returns, but you're not going to make crazy, crazy returns. That's my opinion. Okay. That's my opinion. But is Bitcoin over the next 5 years most likely going to outperform the S&P 500? In my opinion, it will. Like, I think it's quite highly likely that the Bitcoin should make like 15% returns on average over the next, yearly, annually for 5 years going on, like into the future. That's what I can see. I can't see out 30 years, 40 years with Bitcoin. I can't. Like, my brain's just not capable of that. I think it's actually very complex. But my point here is over the next 5 years or 10 years, you could create a portfolio that's 90% S&P 500, 10% Bitcoin, is probably going to outperform the S&P 500. So a very simple portfolios here, and see how I've like weighted it. See how I've allocated the capital. It's like 90% S&P 500. So it's pretty much going to track the S&P with a little tiny bit of upside. Yeah, in those scenarios, there's a bit of volatility there as well. But you can see where I'm going with it. And then you can change the allocations. You could go 50% S&P 500. You could go 25% NASDAQ. You could go 25% Bitcoin, right? Or you go like, oh, so my crypto portfolio allocation is 25%. I could split that into 12.5% Bitcoin, 12.5% Ethereum. It's still 25% crypto. And like, see how I'm thinking here? So right now, I'm just spitting out words to try to trigger thoughts in your mind, which helps you learn and helps you understand. Okay. So it is actually quite simple to outperform the S&P 500. In the business world, there's massive downsides to business. There's massive downsides, especially if you're small and you're starting something small. Like, you just don't have the economies of scale. Like, the more money you have in a business, it's easier to make money. Like, it's way, way, way easier. Especially like if you think about a standard brick and mortar shop. Like, we've got another vessel. It's called Headstart Capital. We invest in ice cream businesses in Indonesia currently. Like, if you only got one shop, it's very hard to be profitable. It's actually really, really hard. But when you get to like five, everything changes. Like, the profit produced from the first shop is now different if you have five of those shops than if you have just only one of that same shop. Like, as an example, like, we have to send like materials from China, and then like it lands in Indonesia in like Jakarta, and then we have to get it all the way to Bali with trucks. So at the start, when we only had one shop, we had to get this little ute. This little ute was bloody expensive for one shop. That chewed up our whole profit. Now we get this pretty big truck, and that pretty big truck, we can load it up. So it's actually pretty cheap. Like, I think before, the utes cost like $400 for a day. And that had a certain size, like, I think, just the back of the ute. Now we've got this big truck, which is like 10x the size, but it's only double the cost. You know what I mean? Double the cost, but 10x the size. So now we can kind of like, before we had to do the ute like twice a month. Now we can just get one big truck for 5 shops once a month. So you start saving money here like that. So yeah, it's not easy to outperform the S&P 500 when you're a small business because you don't have the economies of scale. So you have to find like this little edge. To find that edge is really not hard. Now, what I'm also getting back at here is like one of the main lessons for today. We're in the money game. There's the investing world and there's the business world. The S&P 500 is 500 businesses, 500, and they're just big businesses. They're companies, right? Same thing. It's the same thing. But if you put your mind to it and you have what it takes, and you're not, and sometimes it's actually smart to quit. If you find out you don't have what it takes, just join the S&P 500. That's probably the rational thing to do. Make money somewhere else. But it is actually extremely possible to outperform the S&P 500, and you actually outperform it in a massive, massive, monstrous way. Something that kind of changed my mindset and helped me understand was researching some of the crazy mindsets out of China. Go research a company like Luckin Coffee. Go research them and understand, like, go look at the battle between Starbucks. Like, Starbucks was going so well in China. Then Luckin came along and they got this crazy mindset of just expansion, man. Like, the way these people think is just like, it's insane. Like, the way the Chinese think is like, there's so much competition in China. There's so many people. Like, one state is like an entire country. So like if they were to open like some brands like in hospitality, when they think, all right, we're going to eventually go to Australia, they don't look at Australia like, wow, that's so hard to conquer Australia. Like, wow, imagine if we had a shop in every single area, main area of Australia. That would be amazing. They think, no, Australia's tiny. It's so easy. We got to get the whole thing done in 1 or 2 years. That's their mindset. Like, we've invested, we're franchisee owners of the ice cream and bubble tea brand Mixu, or I think the Chinese pronunciation is like Mishwei. These guys opened up one singular shop in Jakarta, like I'm not sure if the actual first shop was Jakarta. I think it might have been Bandung. They opened up, well, it was like they opened up one shop in Indonesia, tested the market. The market loved the product, loved the offering because there's the cheapest supplier of ice cream and bubble tea in the world. And they do have massive economies of scale. It's a multi-billion-dollar company. That's how they can get the price down so low, and they're all vertically integrated. They enter into the country with one shop. How many shops did they have at the end of the year? They had roughly 1,000. 1,000 shops. If you invest one shop and then have one more shop, that is 100%. If you have 1,000, it's 1,000x, right? Obviously, that the math is not, because like if you do the actual real math, you have to do the ROI compared to all the other shops they had. So they had already like a crazy amount of shops. So like, I'm kind of like fudging numbers a little bit here to prove my point. Like, if you look at the growth of the overall company, all right, it's not 1,000x, but it's proving that it is possible, or it's very, very easy to go from one shop to two shops. That's 100% growth, right? It's 100% growth. Now, the holy grail in physical hospitality businesses is franchising. That's the holy grail to make money and expand the growth of your portfolio quickly. What we're trying to do in hospitality is make a 20% profit margin. Okay. 20% profit margin. That means if you sell something like for $1, every dollar that comes in, 80 cents of that or 80% of that is costs. Now, if you can have a 20% profit margin, that's really, really big. That's actually really, really, really good. Then what you can do as a franchise is you can say, hey, if you want to open up and use our brand, we'll teach you how to run the business and all of that. You'll be a franchisee owner. Then you can then charge them a percent of the revenue. Imagine it could be 5%. Okay. So then the franchisee only makes 15% profit margin. Still pretty good. Or they could get it up to like 10%. Right. Imagine the franchise is charging 10%, which is actually extremely common. That means they are taking half of the profits, because the profit margin at the base level is 20%. They're charging you 10%, which is 50% of all of the profits. Now, the crazy thing is, it works out like this. Imagine the head office, so the company who created the idea, let's just say they invested $100,000 into their shop, right? And let's just say they made like a 30% ROI. So they're making like 30K a year from this investment. As a rough example, okay? Now, their margin's like 20%, right? They can go to another person and say, "Hey, would you like to open up one of these shops?" And they're like, "Yeah, no worries." And they're like, "Yeah, but by the way, we're going to take half your profits." Yeah, they're like, "No worries." Why? Because if they invest 100K, the franchisee invests 100K, they still make 15%. Yeah, 15%. So that's the goal of franchises. The goal of franchise is to create a system that even if they take some of your profit, you still outperform the S&P 500. And the gold standard is to try to make the franchisee earn about 15%. Okay? That's the goal. Because if the franchisee makes 15%, then what are they likely to do? They're likely to open up more shops for you. Because now what is the ROI for this thing? This guy invested 100K roughly, making 30%, and they're making 30K, right? Whoops. Making 30K. And now what? You get a free 15K roughly from this guy too, but you didn't really invest that much more money. See how it's working? So now you're making more money from the same money. And you can just replicate this again and again and again and again. Obviously, it doesn't work 100% that way because to be able to open up more shops, the head office has to build out a team. The team comes with a cost, but it doesn't come with a whole entire shop cost. If you do it fast, right? If you have a team that can help you open up stores really, really fast, or you have like a sales division that can be selling franchises nonstop, you can get the ROI up really, really, really high. Really, 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 really high. So our mindset with Headstart Capital is we're just a franchisee owner at the moment. We're down on the stack. You want to be eventually the top dog. We love and we understand like the business is great. It makes a great, great return. We get well above our 15%, so we're happy. We outperform the S&P 500, so we're happy as well. We want to generate a great, great cash flow, and eventually we will get a cash flow so big that we can become the top dog and we'll create our own brand. And then we can do their strategy and make money really, really, really fast. Okay, and expand really big from franchises. So that's kind of like what a hospitality business is looking for. And you can do that with kind of like with anything really. Like you can franchise practically anything. It's the same thing. So a franchise at the end of the day is how do you make money with other people's money? With other people's money. Okay. So the head office also has a dilemma because if they're making 30% themselves on the base level, they could also think, do we want to franchise and go really quick that way? But then what does that mean? Like there's actually a risk there because the franchisee owner, if you don't train them up too well or you make a deal with the wrong franchisee owner, they can ruin the brand. If you ruin the brand, that's like ultimate risk to the whole thing. You never want to risk the whole entire brand. You need to make sure that the brand's intact. Generally speaking, franchising would then work better on a lower cost type of thing or like a cheaper thing, right? Because for everything to be perfect, it doesn't have to be because the value's already there, that the product's already cheap. Whereas imagine if you're going like top end, like I couldn't imagine having a Nobu franchise. What do you mean you're gonna have a Nobu franchise? Well, you're just gonna get a random guy off the street and he's gonna open up your Nobu. No, it's not a cookie cutter. Like the thing about a franchise is it's better off if it's a turnkey cookie cutter solution for that business owner to come in. They can learn the business really quickly. They can make profit really, really quickly. With a sophisticated restaurant, there's a lot of moving pieces. It's not that easy. Okay, it's not that easy. The funny thing is though sometimes in business, the more sophisticated and complex it is like, yeah, one shop can do extremely well. I've heard shops of making 200, 300% returns. But then what can't they do? They can't scale well, even if it's run by themselves because there's too many moving pieces. They can't actually find the talent to open up the next shops for them and maintain the standard. So sometimes, you got to weigh up all these things. Like I've seen some crazy good operators in the hospitality space where they're just doing unbelievable things. Like I walk in there, I'm like, dude, your place, this is art, man. This is unbelievable. Like sometimes it almost brings me to tears about how good this thing is. Because when I look at everything, I'm like, dude, that's a lot of hard work and sacrifice and thinking. To me, all of that is art and it's actually beauty. But then I look at like, all right, how much money you making? It's like, oh, okay. It's a different story. there's a different story. So I hope you can see like kind of like the mindsets. The top level is using other people's money. Another form of other people's money is like using the bank. Like imagine the bank. Imagine you find out a way to make 30% returns at your place and it's working quite well. Then imagine you get like a bank loan and the bank loan's well under this. Imagine it's 10% or less, all right, for the bank loan. Now, imagine this. Imagine now, instead of like your shop costed 100K, but imagine like the bank's like, bro, I'll give you 100K, right? And then you just like, all right, I'll use the bank's money, 100K to open up a shop. I put no money in at all. I just need to pay 10% on that 100K. It's like an infinite return. Or like what you can do is like you can do the math like this. Hey, I'll actually put a little bit of my own money. I'll put 10K of my money, and to make it just look a little bit nicer, I'll put 100K of the bank's money, and then I just need to pay 10% to the bank on this. But now my ROI is based on this. Like, what is the cash on cash return? It just gets pretty damn wild. Okay. There's always downsides of this. Like, imagine if all of a sudden you can't repay the bank, you actually make less return than the interest. All right, now you're in a bad dilemma. But again, there's an opportunity there. If you can play it right, then you can make even crazier returns by applying a little bit of leverage, okay? Applying a little bit of leverage. And now a lot of people, what do they say? Bank loans are not safe. Bank loans are not safe. Don't apply leverage to a business. Never start a business with a bank loan. I agree with that one. Never ever start a business with a bank loan. Don't you dare. Don't you even think about it. Don't you even think about starting a business with a bank loan because it's not proven. Open up, but imagine you open up 10 shops. They all make 30%. You probably have proven something that you've got a proper business model. Now you have to forecast. Because I've gotten to a stage of like 10 shops, now you're going to start attracting attention from other big players. Do they have the ability to destroy you? They might. All right. So sometimes there's this thing where you're kind of under the radar for quite a while. Because like if you see a little shop popping off, like a big investor's like, all right, is that an idea that I can truly copy and then truly scale out to my size? Because if I already have 500 shops and I can only open up one of your shop, right, by copying you, that's not really affecting my overall company's ROI. But then imagine you get bigger and then they start saying, oh, this thing is scaling. And then they go into your shop and they look at your operation like, hey, we can do way better than you. And then they can see like, oh, they can tell like you're making good returns. Then they will come in, you attract them, and that's capitalism. So at the end of the day, it is kind of a bit of a war. And that kind of relates back to how I was saying like you gotta have that dog in you. You gotta have that dog, and you gotta get ready to fight back. You got ready to get ready to fight back. Um, to get a little bit personal with you, like this is quite controversial, but I've seen people like maybe even partners in the past where, like, if you think about some females, and it goes with males as well, but sometimes they're more innocent and, like, what's the word for it? Like, they're happy-go-lucky type of people. I'm like, oh, I wouldn't want my girlfriend to come across me in business. I wouldn't want that for her. Like, you know, there's some really smart girls and they can use their intelligence, but like sometimes I feel like I don't know, a man has that hunter gatherer thing inside of them. Often they do. So I just be wary of that. Like, I feel sorry sometimes. I feel sorry. I don't like I got this, some men have this thing in them, like they just want to work, like like a dog, like an actual dog, like those type of dogs. Like you just need to take them out and let them run, and you feel like a 2 minute run's enough. No, and they start sprinting. No, they don't get tired for half an hour. You have to just let them run all day long, right? Then there's the other dogs. They just like to snuggle up with you and cuddle and take it easy, relax, and they're just sleeping all day. So that again, that goes to like I've been generalizing here, right? I'm just being generalizing, but like you have to look at yourself, and also when you're thinking about hiring your team out, think about the team. Do they have the dog in them? You don't want the ego dogs, which they think they're top shit, and it has to be a balance between intelligence and the grits and the focus and all of these aspects of what makes a good money person. All right. I think we've had some pretty good lessons here. What are we at? 34 minutes already. What else did I want to say? There was a good thing I wanted to say. Well, I forgot. It's gonna come to me. Hmm. Okay, I remembered. Now, when you're doing business or investing, it is often probabilities. So I always say you want to try, I believe it's very good to try to see the world in numbers, see the world in probabilities. Like you can never have such confidence that you know for a fact what the outcome is going to be of your decision. You just cannot know 100% accurately. That's like whenever I talk about the stock market, when I feel like I'm pretty damn confident, like in my head, I feel like I'm 90% correct. I'm just going to say to you guys, I'm 70% correct. And thank God I say that because most of the time it is actually 70% correct. So whatever is in my head is actually not correct. Okay. So I always like save myself by saying 70% instead. Now, think about this, like when you're investing in a business, let's focus more on like the business side. Everything, if it's a physical business, let's use the ice cream business as an example, ice cream restaurants, all of that. 51% of the value comes from the location. The location is everything. To prove the point, right? There's some brands whereas like if they open up that shop in a certain area where it's not ideal, they go bankrupt really quickly. But sometimes if they find like the perfect location, they still make a good ROI and it might actually be like 30%. Then they get some decent locations, then they make like more like 10 to 15%. But they're quite limited because of the actual offering of that brand is like not really that good. So they kind of, that they're kind of constrained and they can't expand that rapidly, or they would have to think about, hey, like actually I can only open up like 5 or 10 in this city. I'll then have to go and travel and then have to think like, am I willing to travel to another city, to another state or potentially another country? Do they have that in them? Are they willing to put in that extra work to do that? Whereas other brands, the offering is so great that they can just practically open up anywhere. That's kind of like Mixu in Indonesia. Like they can practically open up anywhere and they're going to make money. But if 51% of the value comes from the location, no matter if it's a great offering from a certain brand or, a not so good offering, finding the right location drastically out changes the ROI. Like it can change it a lot. I've seen brands where they average 15% ROI, but then by choosing the right location, you can make 100%. Big difference. Because if the average is 15%, there's outliers that are making 100%. There's outliers that are losing money too, and it averages out to 15%, right? Now, if you can understand these lessons, you can kind of try to, in a way, put the probabilities on your side that all of your shops are outliers. Now, you're not going to get all of them as the outliers, but there's ways that you can increase your probabilities that you're actually aiming for 100%. Like I mentioned, you open up a shop, I think you should aim for 100%, especially at the beginning. Eventually, all of those great locations, they may go. So you might not have any 100% compounders left to get because you've grabbed all the land and there's no land left, right? Like, it's actually really, really hard to get those A-class locations. Like a key is like, you actually want to build out a real estate division, which understands the locations and understands the mindset of the company so well that they're always scouting. Like I see so many amateur business people like, oh, this is the best location to open up a shop. That shop's taken and it's been taken for 20 years because it's so profitable. That shop is never going bankrupt. You can't just say, hey, I'm going to open up if I had a business, I would open up right there. No, you have to wait for a full lease, right? Or, the building has to be for sale. The best locations, they don't come up for lease or for sale very often. That's why you need scouts, a real estate division scouting those areas. And you can say, hey, like, yeah, we think this location is literally perfect. If this ever comes on the market again, boom, we have to get notified. So you need people checking that, constantly. Okay. So What I'm getting at is it's probabilities. It's like a roll of the dice. This is where I'm on trading view right now. I was supposed to be drawing up this whole time, but I forgot forgot to. A dice has like six sides, right? A dice has six sides. And what are those numbers? Those numbers are like one, obviously one through six, okay? One, two, three, four, five, six. Whenever you're about to invest into a location, you are rolling the dice and you do not know what number you're going to get. Now, a less intelligent person, less sophisticated, less experienced, their dice has numbers on it. Their dice is more like, it doesn't say one through six, it says 50 here, minus 50%. This one says minus 25%. This one says 0. This one says 10 maybe. This one says 20 and this one says 30, something like that, all right? So what I'm getting at, these are annual returns. You roll the dice, based on the location, you may get a minus 50% ROI. That means in 2 years, you got no money left. This one, all right, you might have enough cash for 4 years and then you burnt through your capital, you're done, right? That's if you actually have cash left over. Some people, when they open up a business, they don't actually have any cash. So a minus 25% could chew through you might only have 25% of cash stalls. Like often businesses only have a 10%, you know. So in 6 months, you've gone through all your cash, you might actually go under, right? Um, this one's break even, so you don't necessarily have to shut down, but you don't make any money as well. Then this one's a 10% return, 20% return, and 30%. So this is quite of a standard dice. It's quite a standard dice. But as you upgrade your knowledge and get smarter and through experience, you can actually change the dice itself, right? So then instead of having these numbers, you could have like, all right, you could still have one that loses, but maybe the worst case scenario is minus 10. Then you got 0. Then you got like 10, 20, 30, and then maybe 40. But this is actually a pretty damn good dice here because most of the numbers are positive here, you know, or like above 0. So only one, like you got a 1 in 6 chance to lose money, kind of. See how I'm coming with it? Like going with it? So as you get better and better and better and better and smarter and smarter and smarter, you can actually change the business and the data of the business can actually change. The probabilities of the business can actually change. So, you know, currently with our company, we're making pretty damn decent returns, but I think and over time, we can see how our decisions and the location affects our company. So we're gathering that data and we're actually getting more sophisticated and getting better, and we're creating a better dice now. And so the dice can change in two ways. One is with the ROIs, but another way is you can actually increase the sides of the dice, right? So you have way more sides, and maybe it could be like minus 10, 0, then 15, 15, 15, 15, 20, 20, 30, or you could have an outlier that's like 100% potentially. So you can kind of change the probabilities over time as you constantly improve yourself. So this kind of relates to the Japanese philosophy of Kaizen. Like you just want to constantly improve because there you will get rewarded for it, right? But you need to be improving faster than your competition is improving because at the end of the day, it's going to get harder and harder and harder and harder. Business probably will get harder and harder and harder into the future, especially with hospitality. As an example, right? Right now in Bali, you got two main markets, okay? I use Bali because most of us have been to Bali, or at least we can picture it. You can kind of, do this with any like tourist area. So imagine you got the tourist area. In the tourist area, the businesses here are catering towards tourists who are coming with big money that they want to spend and enjoy their time. So they're willing to spend more. That means it attracts a lot of dollars. If it attracts a lot of dollars, it attracts a lot of competition, right? Because these people are high spenders and they don't really care that much, right? Then you got the local market where the locals, right? The locals, and even think about yourself in a certain scenario. You yourself are going to spend more money when you're in holiday mode than if you're in living mode and working mode, all right? So it's more like that. So The businesses here in the tourist area, they've attracted, especially in Bali, they've attracted some world-class chefs. They've attracted some world-class operators. But over time, to survive, it's capitalism. Over time, you cannot say, hey, if I open up something that's like 5% better than the average of the market in this area, that I will make these returns forever. You won't. Because then someone will make something that's 10% better than you, right? 10% again and again and again and again and again and again. Like you have to think, where is the market heading? How long is it realistic that I can make these returns for? What is my moat or my defense? So Warren Buffett is famous for always saying, your business needs to have a moat. That's the big, lake around your castle to protect your castle. That's your company or your business or your investment. You need to have a lot of crocodiles in your moat. You need to have a really wide moat as well. So when people come to attack, they get chewed up by the crocs. So you have to think about where is this market heading over time, because maybe you're only going to be super profitable for 5 years, then the market's rapidly changing and rapidly getting better and better every day, that at a certain point, there's a tipping point that there's so much more supply of great businesses better than yours that why would the customer ever come to you? Okay. So that is also the same thing in the local market as well. A lot of people, they always say like, oh, just invest as cheap as possible. That means you can make more ROI. Yeah, you might make more ROI today, but in 5 years' time, you're vulnerable because you have no moat. Now, that may not be the worst decision to go really, really cheap now if you can be super profitable now and make a bigger ROI now in the short term, because then you could use those profits and reinvest it back into your business in the future. So then in the long run, you actually make more money than if you invested really big and spent money in a way it's not necessary, right? At the start. So one mindset is, hey, like we understand that whatever market we're investing in, it's going up like this over time. Right now, in this moment, if we zoom in on it, right, we believe our business right now in this moment is better than all of the competition. Okay, all right, it's better than all of the competition right now in this moment. Then what? 2 years later, you're the average. See? 2 years later, you're the average, okay? So where are you actually in reality? You have to get a good understanding about how to value your company without a bias. Value your business, your offering without a bias. Maybe you got like a 10-year gap on these people, right? You could have a big 10-year gap. Then in 10 years' time, you have to reevaluate and you have to invest back into the business. So you can get really, again, you can get really nuanced with it. And it's about allocating capital back into the business. Do we allocate 10% of our profits back into the business? Where do we invest it? Is it better to invest in the floor, better to invest in the walls, better to get new tables, new furniture? What do we actually do? This is relating again back to Apple when they're thinking, how much money do we allocate behind the iPhone? What do we do? Like sometimes I'm just guessing here, all right? I'm just using my business hat. I'm just guessing here. Why do sometimes the cameras not change that much for like 2 to 3 generations of the iPhone? Or there's like one thing that doesn't really change that much. Usually it's the cameras. I got a feeling it's because they're saving up their money, producing more money potentially. I don't know if it's with Apple. Maybe I don't know. They could be just making that much money that they don't think about that stuff. But I got a feeling that's what they're doing. So that in 3 years' time, then they hit the market with something crazy. They get way more capital and invest way bigger and they shock the market. And then it looks like a big change because they know the cycle of the customer to buying a phone is like 3 years. So they could what is actually better for producing profit? I don't know. I'm just chucking it out here and thinking out aloud. This is how we think in nuances. Is it better to make the iPhone like this and then the camera like that and like that and like that? Or is it better to like make it a tiny, like make it like first one's this, second one's this, and then the next one you use all the profit and you make it like that and you shock the market and it's like a big thing all of a sudden, Which one actually um transfers into making the largest ROI or profit from the customer. Because sometimes if you just make little incremental improvements, the customer doesn't really notice, and the customer kind of gets bored. Or like if the increments are not big enough, you're like blind. Like the market's blind to you. So yeah, they're just chucking it out there, just trying to show you more evidence of like how to think. Like I actually haven't done the research about it, but it's like my mind just automatically goes there when I look at Apple or if I look at a different company. I'm trying to think like, whenever you go down the street, you take note, like, why did that business choose that location? Why did they choose that type of interior design? Why is that interior design dark? Why is that one light? Why did they use these wooden materials? Why did they use this tile? What's the benefit of wood? All right, wood is it feels it might feel more cozy. What is the better of bright? Bright might be more inviting from the street. Like you see this big bright shop, it looks more friendly. Whereas you see like a dark shop, it's like, oh, it's a little bit scary. I don't want to go into that cave, right? Or you use a more classic font. It seems more sophisticated. All right, compared to like maybe a street art graffiti font type of font, like what's that doing? That's attracting a different market. So you can go through these different things. What does it mean to have a lot of plants at your shop? Is that a good return on investment? Hey, what do plants do? Well, plants are kind of like the wood. It's kind of like the bright thing. They're kind of inviting. We live in a digital age. People are attracted to plants. They don't even realize it. Some people. Oh yeah, by the way, plants, they can grow really fast. A plant can double in height every year. Wait, it's 100% compound. Wait, that's an asset. Wait, so as long as we don't kill it, it's an asset that grows really, really fast. See how you can start to think in this more sophisticated way. Everything has a value. Oh, let's put this really cheap wooden floor in. Oh, but by the way, if we don't maintain it and don't varnish it, it's going to be ruined in 3 years. Wait, what does that mean? That's a lot of depreciation to the business, right? There's a lot of maintenance cost. Why didn't we just maintain it properly from day one? Start thinking about all of these different things, taking notes. I also like whenever I see a business and they're building their shop, I always kind of think, all right, based on that location, what do I think the sales is going to look like? And I don't know, I don't mean the actual number, but like how many bums in seats are they going to get? How busy is it going to be? Sometimes you get proven wrong. Like, dude, that location, I would never invest there. And then all of a sudden you see it pumping, and it doesn't pump for like a week. It pumps for 6 months or a year. So, just do these little experiments in your head and be honest with your head, like in your head. Like in investing, it's normal practice to have an investment diary where you do these things. I think we should also have a business diary as well. Just make these little predictions. Like if you got a group of mates, whenever you walk past one, just stop at the front, like, boys, we'll have a quick discussion about this. Train the business muscle, train the investing muscle, train the money making muscle. All right. I think that's everything. This is practically the foundation to the meta thinking behind making money in investing and business. I think this is like the 20% which gives you 80% of the results. Yeah, it's about an hour long, but I hope there's been action packed with a lot of value for you. I hope you liked it. If you did, please go and share it with someone. I think these are great mental models to work off of. If you've got anything to add to that or any thoughts, I'd love to hear it down below in the comment section. And yeah, I'll see you in the next video. Thank you very much.